How's your real estate investment holding up? What's going on in the real estate market? Is the market good? Is the market problematic? Well, let's answer these questions. This is the November 2025 real estate market update for the Las Vegas Valley. I am Justin Miller, the co-founder and principal at the Chong Miller Group and your co-host for this video. So before I dive into the information, I want to just mention something, and that is I'm recording this video on Tuesday, November 11th. Now, I waited to record the video because I thought there might be some important and interesting things happening in the macro environment, and there are, and we'll get to those. But I had wanted to wait to see if we'd be able to get some settling of the issues before I recorded this. Nonetheless, like always, I pulled the actual data, the housing data, on November 7th. So this is the November update. It is all of the information about the Las Vegas real estate market that was in the multiple listing service databases as of the 7th of November, so all of October. Okay, with that, let's go ahead and set some background, and then we'll get into the real estate data itself. Remember, the background is sort of what's going on in the environment that's actually impacting real estate. And that's important because we know that people don't simply decide to buy or sell in a house or a condo or a townhome in the absence of other stuff going on. Some of that stuff going on may be very personal to them. It may be a change in family circumstance. It may be a change in employment circumstance. But it may be related to the regional economy. It may be related to the national economy. And so these larger issues impact more people. And so we want to be able to look at those because they give us a better understanding of how the market overall is unfolding, which itself is something that impacts the individual. You as the buyer, the seller, the investor. Okay, so this issue I was waiting to see if there'd be resolution on. On the first Tuesday of November, we had an election in some states across the country. That election, okay, fine, but we were in the middle of a government shutdown. And so the election results from that night potentially would influence the trajectory of how negotiators, senators primarily, would engage in further deliberation about how the government could be reopened. And I had actually predicted myself, there's no way you can validate it, but I had predicted that within 1 week after that, so by Tuesday evening of the following week, by the evening of the 11th, we would actually see a resolution of the government shutdown. That the results from the election were pretty stark, and that they would point the way towards some ability to reach the consensus required, the compromises required to reopen the government. Well, I was maybe a little bit too optimistic on that. Here we are on the following Tuesday, the 11th. It is not evening, it is around 10 a.m. as I'm recording this. And we have what appears to possibly be a resolution, but it's going to take another couple days to know whether or not that's true. So last night, the Senate just happened to vote 60-40 for a compromise that will reopen the government. The details of that compromise are actually not fully clear in the popular press right now, so we don't know all of those details. But that has now resulted in the House being recalled, the House of Representatives being recalled to Washington to make a vote. And they may do that on Wednesday, they may do that on Thursday. Assuming that the House is able to pass that budget compromise, then that will go to the president, and assuming that he actually signs that, the government would reopen. So by the end of this week, by Friday or Saturday, we should see the government open, which will be great. Now, one of the questions that arises, is this a permanent solution that gives us a budget for the entire year? Or is this a partial solution, a continuing resolution that only pushes us a couple months into the future, like maybe the end of January, and we have to go through all of this all over again? Or is it an incomplete full solution where it funds certain parts of the government through the end of the year, but other parts of the government run out of funding maybe again at the end of January or at some other time. So we don't know all of those details yet. I'm going to say, okay, we've reached resolution, but again, I may be slightly optimistic. It may turn out that no, this all collapses on itself, or it's just resolution for a couple of months. So keep that in mind. I will say the government shutdown has lasted, today is the 42nd day as I record this. It is fully 1 week longer than the prior longest ever in American history government shutdown because of a budget issue. By the way, that happened during the first Trump administration. This one, the second Trump administration. You can read into that a whole lot about whether or not the current administration really cares about the government delivering services, really cares about whether or not the government should exist or should be open at the same time that he's tearing down the White House. But that's, your call for figuring that out. The problem is, though, regardless of your political beliefs, the government being shut down simply increases dramatically fear and uncertainty. And so a small business survey just released the day before I'm recording this on November 10th said that actually small business confidence has fallen significantly over the past 2 months. Well, certainly understandable why that would be, right? Where revenue is going to be coming from because consumers may be harmed, et cetera, et cetera. All right. So we've got fear and uncertainty, even if the government is opening, and we have a lot of uncertainty about what that's going to mean. That sets the first level backdrop against which buyers or sellers or investors in real property will be evaluating. Is it time to do something? Is it not time to do something? Next issue, consumer sentiment. So I just talked about what small businesses are feeling, but what about consumer sentiment? Well, actually, every month the Conference Board and every month the University of Michigan release 2 separate consumer confidence surveys. These are both very high quality information that have existed in about the US economy for I don't actually know how long, but long durations, like 50 years. So very good at asking the questions, looking at the data and parceling out what's actually going on with regard to consumer confidence, both forward-looking, current expectations, and a couple of other ancillary issues that sort of feed into the overall confidence measure. Confidence fell significantly during the month of October. And actually, consumer confidence is plumbing the depths that were found in 2020 during the COVID shutdowns. So consumer confidence, clearly largely influenced by fear and uncertainty, is really problematic right now. And that's impacting people's decision to buy cars, buy houses, go on vacations, etc. And so something we want to pay attention to going forward in time. One of the things the current president had campaigned on, drill, baby, drill, or drill, 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 2 different versions of the same motto, and has said repeatedly is he wants to be known as the president who gets all of this oil drilling going on, oil out of the ground. What's kind of interesting, because at the same time that the current administration is attacking solar power and wind power, we actually see something weird going on in the oil markets, and that is the US continues to import approximately the same amount of oil that we had been importing last year and the year before under the prior administration. And even more, drilling has slowed over the past year. And so the rig count, a number published by Baker Hughes every single week, tracking the number of rigs in production, oil drilling rigs and gas drilling rigs in production in both the US and in Canada. US only data, the rig count year over year is down 65. Now that seems like, okay, whatever, it's an interesting number maybe, but what's that compared to? Well, it's down 65 to 414 rigs. So in other words, it's down about 15%. So with all the drill baby drill, the economy has been sufficiently uncertain that the oil majors, as well as the shale producers that would be engaged in actual drilling, have been cutting back on drilling. So when I say there's fear and uncertainty in the market, I really mean it, right? We've got all of these indicators, and we'll see it in the real estate data as well, but consumer confidence is down, small businesses confidence is down, driller business is down, right? These are across wide spectrums of the US economy where we're seeing fear and uncertainty driving down economic activity. Okay, just the reality. As I'd said last month, are we headed into a recession? Yes, absolutely. Will it happen in the fourth quarter of 2025? Possibly. Will it happen early in 2026 if it's delayed that long? Definitely. We're going into a recession. There's no two ways about it. Now, recessions do not mean falling housing prices. Actually, housing prices tend to go up at a slower pace during recessions than they go up during economic booms, during economic growth times, okay? So it's not something to be worried about as related to housing prices, but it's still something to be concerned about, at least to the extent that recessions are usually denoted by higher levels of unemployment. So you want to make sure that you're saving money, you're putting yourself into a position where you have the ability, the wherewithal to get through a time of lesser economic success for you and your family. And that may mean investing in property, but it may mean cutting back on some of the discretionary expenses. So, all right, next thing, transaction volume, I pointed out over the past multiple months of 2025, continues to run at a generational low level. That's real estate transaction volume, specifically in Las Vegas Valley, but this is actually true across most of the country. Not every place in the country is experiencing the exact same thing in the real estate market. Real estate markets tend to be very local, but it happens to be true that across the country, real estate transactions are low. And part of that's because of fear and uncertainty. Part of that's because of interest rates. We'll talk more about that in a minute. But it is true that in 2023, we actually saw the lowest transaction volume for residential resales in the Las Vegas Valley in a generation. In 2024, we were up by 2.4%, just barely up relative to 2023. And in 2025, so far through the end of the 10th month, right, most of the year is in, we're running below 2024 levels, we're running below 2023 levels. Right? When we get to January, when we get the actual numbers, 2025 is going to be the lowest transaction volume literally in a generation in the Las Vegas Valley. And I make that statement with confidence because November and December tend to be the lowest transaction volume months of the year. And that's because of structural reasons like holidays and vacations. And so even if transaction volume were to increase in November and December, the months remaining in front of us, it's not going to be enough to overcome the deficit that we're in vis-a-vis 2023 and 2024. So we are looking at, we'll continue to look at through the end of this year, the lowest transaction volume in Las Vegas in a generation. All right, what about interest rates? Well, the Fed in October cut interest rates by a quarter point. That's 25 basis points, right? And now remember, the Fed only cuts interest rates or increases interest rates on the federal funds rate. That's an overnight lending rate, effectively that the Fed tells banks to lend money to each other for one night. That's it, right? It's a signaling rate or a policy rate that the Fed uses to let the market know what the Federal Reserve thinks should be happening across the interest rate complex, across all of the different types of loans. But it's only a signaling process. And rates are actually for treasury bonds, for mortgages, for cars, for whatever, are set in a market where traders, buyers and sellers of bonds, are actively engaged in the trade of those bonds, determining what those interest rates are, right? And so they receive a signal from the Fed. They may or may not like the signal. So the Fed cut interest rates in September by 25 basis points, and they cut interest rates in October by 25 basis points. That's half a point, right? So if we were thinking, well, does that drive down mortgage interest rates by half a point? Maybe not so much. So interest rates actually fell in October by 0.1% or 10 basis points, not by 50 basis points, not by 0.5%. And mortgage applications were down. Now, refinance applications were up. So this is good for the banking sector in some manner. It's good for employment among loan officers in the banking sector. But it's not doing a whole lot for the housing market. Well, why not? It's because interest rates are not the only thing that's driving what's going on in the real estate market. I just told you about fear and uncertainty, about what's going on in the macroeconomy with the oil majors, with the macroeconomy with regard to consumer confidence, and the macroeconomy with regard to small business confidence levels, right? And so, yes, interest rates have come down slightly, just slightly, but that's having a very small impact on what's actually going on in the housing market right now. Okay, and by the way, on those mortgage interest rates, right, the Fed made their October rate cut at their FOMC meeting, their Federal Open Market Committee meeting, in the middle of October. Well, we actually saw mortgage interest rates backing higher in the second half of October, right? So they ended 0.1% lower than they had ended September, but they had actually gone down a little bit further and then backed up. In other words, the bond market's not really liking the messaging coming out of the Fed right now. And some people are saying it's because the Fed followed up that meeting by saying they may not make another interest rate cut this year. I doubt that's the actual reason. I think rather there are other reasons around inflation and unemployment levels that are causing bond traders to be nervous and demanding more interest on the bonds in order to be able to purchase them. Right? Remember, bond prices and interest rates move exactly inversely. So if bond demand goes down because of fear and uncertainty among bond traders or because of concern about higher inflation rates, that means interest rates go higher, an exact inverse correlation. So anytime you see interest rates going higher, it means that there's less demand in the bond market. So the Fed signals, hey, everything's great and we're lowering interest rates. But there's fear and uncertainty in the bond market causing bond traders to say, maybe not so fast. Maybe I'm not interested in those lower interest rates. I want higher interest rates, right? That's literally what happens. That's why the policy rate is a signaling rate. It doesn't actually change what the interest rates are that are available to us as consumers or purchasers, investors. All right. Now, one other thing about the Fed, I did mention last month, what the Fed should actually try to do is engage in some quantitative easing. That is, going into the bond market, demanding receipt of bonds, payment for bonds. That increased demand would cause interest rates to go down. The Fed could, through quantitative easing, be very strategically focused on a particular portion of the bond market and change bond prices and consequently interest rates very directly, lowering mortgage interest rates. So kind of interesting, one of the Fed governors just last week, the first week of November, announced that the Fed is probably approaching that point in time where they're going to stop quantitative tightening and they may shift into a small purchasing stance, a quantitative easing stance. I'd suggested last month that's what they should be doing instead of cutting the Fed funds rate. They didn't do it. I'm not claiming that they listened to me, but at least one Fed governor is now talking in the direction that I'm suggesting. And we might see that actually unfold throughout 2026, which could be really good next year for the market. And by the way, just foreshadowing, remember it is November, which means that about the end of this month, the very beginning of December, I will be creating my 2026 market forecast video, where I will be making all of my predictions for what happens in the real estate market in 2026. Okay, so stay tuned for that. And by the way, so that you know that that video and the other market videos are out, please subscribe if you haven't, hit the notification bell, hit the like button. Okay, let's go ahead and move into the actual data for October of 2025. Prices. What happened with prices? Well, good question. Single family home resale median sold price. So I've put in here on the ticker on the bottom, if you will, that it's up 1,000, right? It doesn't matter. You can call it flat. It's up 1,000. It's up 0.2% if you want to call it up 1,000. It's down 2.1% year over year. Now, this is not insignificant. Right, it's a small drop. Usually in a typical year in real estate in Las Vegas, we're expecting to see something about 5% growth in prices. So we're substantially below what we'd expect in a normal year in the market. But overall, we're down 2.1% year to date. I think that we're actually going to come out a little bit better than that by the end of the year, because we actually saw prices go down in December of last year. But we'll find out. We might see prices go down a little bit this year as well. As I mentioned last month in the October update, we may frequently experience a little bit of just flatline price fluctuation every year, depending on season in a real estate market. And so to the extent that we see flatline, meaning no growth in prices, flatline fluctuation in pricing, we tend to see the strongest pricing in the sort of June, July timeframe, and the weakest pricing in the November, December timeframe, when there are fewer market participants. And so we could see a little bit of downward trend in November and December in pricing. And I use that word trend very advisedly. It's not actually a trend. It's just simply a seasonal fluctuation that happens. So we might go down very slightly from here. We might not go down slightly from here and just stay very flat. We could see a slight bit of price growth, but it's quite unlikely at this time of year. What about with condos? Condos, we were down. We were down $1,000 or to $225,000 at the median. That's down 0.4%, but we're down 5.8% year over year. That's a real drop, right? That's a consequential drop. If you have a condo, you've been seeing prices over 2025, as well as the number of transactions, definitely weak. Okay, so that's a true statement. There is no way around it. Now, this isn't a collapsing. There's not going to be any kind of collapsing. But that is a small drawdown. Now, if you bought a condo and you put down 10% when you bought it, and you bought it at the top, you're fine. You're still, above break even. If you had to sell it right now, you do have transaction costs, but you're not losing money. It's sort of the top line figure on the property. I don't recommend, if you bought a condo in 2024, that you would sell it in 2025. Generally speaking, if you're selling a property more quickly than 3 years, you may be making a mistake. Not absolutely. There's some times where it can make sense, but generally you want to have a time horizon of at least 3 years when you're buying a property. Okay, townhomes. Townhomes down a little more substantially, down $5,000 to $330,000. That's down 1.5% month over month, and we're down 7.0% year over year. We've seen weakness in townhomes over the past 2 months. I think this is a a reflection of some issues taking place in the market right now, more than it is about the particular sub-market for townhomes. I don't think townhomes are going to be losing value vis-a-vis the rest of the market. I think they'll be trading approximately in line. But yes, it definitely is true. We're down, not insubstantially, right? This is actually a somewhat large decrease on a year-over-year basis, down 7%. Pricing insight. Price per foot, approximately flat from the month prior across all market subsegments. What that means is what we're experiencing in the lower price tier of the market and what we're experiencing in the upper price tier of the market and maybe in the median price tier of the market, they're all about the same. We're not seeing big divergence that very expensive homes are doing super well and inexpensive homes are doing badly, or vice versa. We're seeing actually a fairly consistent result in the market across the different market subsectors. So next issue, what about the number of units sold, right? And this is where we're actually seeing really significant impact of uncertainty. So single-family resales, single-family residential resales in the Las Vegas Valley, 1,559. That's down 120. Now, these are the October numbers, right? October is not a month where we see seasonal downturns because, right, we're not in that holiday season yet. We've got people back in school, sure. Lots of houses transact in the Las Vegas Valley while people are in school for various reasons. In fact, we see nicer weather in October, which is bringing people back out to look at things after the very hot spell of July and August. Maybe not so hot in January. And so anyhow, that's a significant drop in number of transactions. And by the way, pricing held up flat to up $1,000 for single family resale, even though we saw 120 or 7.1% lower number of transactions for single family resale during the month of October, right? So that's a pretty big hit to transaction volume in October. And in the October market update that I did based on the September numbers, I had highlighted pending contracts in September were actually higher based on people's belief about what was going to be happening with interest rates and not yet having a closed down government. But I had suggested we'll see what happens. We may actually see a number of those pending contracts drop out, maybe a higher number. We'll get there, okay? Hang on, because it's an important thing to be looking at. So we're down 7.1% month over month for a number of transactions in October vis-a-vis September. That's a big hit. We're down 8.1% year over year for the month of October, right? Vis-a-vis October 2024. For single family resale, right? So if we thought that the September rate cuts were going to spur sales and the October rate cuts were going to spur sales, well, we're sure not seeing it in the October data, right? We're already running at a rate below 2023, the slowest in a generation year, and we came down 8.1% from what we saw last year in October. Right now, I will comment actually, last year, October and November were the 2 months that caused 2024 to actually be better than 2023. If it wasn't for October and November of last year, 2024 would have been virtually identically flat to 2023. Right. So that we fell relative to October of last year means that the interest rate cuts we've seen this year have not given us the same kind of boost yet. They won't, in all likelihood, have not given us the same kind of boost that we saw with interest rate cuts last year. It's because the government wasn't shutting down last year. We didn't have lots of tariffs and tariff-induced inflation issues last year. We were actually in a very strong employment growth environment 12 months ago, where now we're actually seeing employment levels falling unemployment levels very slowly rising, right? So the economy was really different. Fear and uncertainty looked really different when measured last year. The consumer confidence numbers were looking quite good in October of 2024, right? So interest rates saved October, November of 24, not doing the same thing now because we have all of these other drags on the macroeconomy. Now, that's single family homes. We had a little bit different story, maybe a more encouraging story for condos and townhomes. For condos, we saw 232 sales closed, resale sales closed in October. That's up. It's up 8, okay? It's up 8, which is still 3.6% month over month because the condo numbers are very small, but it's down 10.1% year over year. Same annualized story for condos. So yeah, we're floating around at low levels, really low levels, generationally low transaction levels. We're down 10.1% year over year. Townhomes, 193, up 3, or 1.6% month over month. So up 3 from what we saw in September. And we're actually flat year over year. Literally, we're flat year over year. So townhome transactions held up relatively well. But that's really the only submarket in which we can say we've got kind of encouraging news that showed up in October, right? Otherwise, we've got to look at this and say, okay, prices held up fairly well, transaction volumes down. Now, sold insights, pendings for single family and condos did both go up in October. We're going to look at some data that questions the validity of that insight in a little bit. But pending transactions were down for townhomes. Not a lot, but they were down marginally. All right, year to date, 2025 numbers still running great, and that's the cumulative. I've not done the actual calculation, but they're still running significantly below 2024 and below 2023. All right, so next issue that I want to talk about, and that is inventory. Inventory has been behaving very interestingly, right? A lot of people had been saying massive levels of inventory, everything's going to be crashing because everybody's trying to sell and blah, blah, blah. Fortunately, that story has largely gone away. We still do have relatively higher levels of inventory than what we had been seeing since 2020 for most of the time that we've been looking at the market since 2020. Now, we actually had seen a big bump in inventory in the May 22 through October 22 timeframe when the Fed increased interest rates really dramatically. But then inventory levels had come back down. Most of 2025, we've not been looking at 1 or 2 months worth of inventory sitting in the market. We've been closer to 4 months. Now, some people have been saying, buyer's market, sellers have no power, buyers have all the power. It's kind of not true, right? We've talked about this for a number of times. One, we don't really see a balanced market until we get between 5.5 and 6 months worth of inventory sitting in the market, right? That's when you start to see buyers having significant power. And 2, much of this inventory is fake inventory. It's priced so inappropriately that it's just not real. For sellers who are pricing their houses, their condos, their townhomes properly, they're still commanding their prices in the marketplace. They're not seeing big drawdowns because buyers have negotiating power. It's just not the case. Multiple offers, there's few people transacting in the market right now. So multiple offer issues are going away, but frankly, that's healthy for the market. But we're not seeing lots of buyer power out there. We're seeing sellers with small amounts of seller power, and we're seeing a whole bunch of sellers who are just out of their minds, or listing agents who are out of their minds. Put the blame on whichever category you want. Okay, so what happened in the reported inventory? I'm not going to look at the real inventory for the numbers in October because I don't want the video to go long and because we're approaching the annual forecast video. So I want to keep this a little more constrained. But for the reported, right, inventory, single family resale, 7,445, that down 405 or down 5.2% month over month, right? Fairly big draw off that inventory number. It is up 12.3% year over year, and I'll address that in just a minute. But it's interesting, right? So inventory is definitely running higher than it was last year. Condos, 1,543. That's down 89. Again, a pretty big drawdown from the September number to the October number. And remember, October is not a month where we should be seeing seasonal drawdowns, right? We'll see that in November and December. October should be a fairly normal month across the year from a normal seasonal pattern. We're down 5.4% month over month vis-a-vis September of 2025. Inventory is up 12.5% year over year for condos. Again, definitely substantially more than what we saw last year. Townhomes, 1,149, sitting in inventory waiting to be sold, resale townhomes. That's down 19, small drop, but it's down 1.6% month over month. And it's up a very substantial 51.5% year over year. Now, two insights with this. One, all market subsegments, single family, condo, and townhomes, saw annual inventory growth slowing. Right? And this is actually the 7th month where we've seen that annual growth, right? Single family 12.3%, where we've seen that annual growth going down month over month, the annual comparison, right? So in other words, inventory, yes, it's higher than it was last year, but the gap between what we saw last year and this year has been shrinking every single month for the past 7 months. That's a long trend in place. And it's, fine, I guess, qualitatively that we're seeing inventory go down a little bit because we're sitting at about 4.5 months worth of inventory in some of these sub-markets. We can afford to have a little bit less inventory in the market. But the story since 2020 has been really low inventory, right? We've never caught back up. We've never gotten to normal inventory, let alone balanced market inventory in this market. That's a really significant insight that you need to pay attention to. And inventory is falling, right? Month over month, it's falling. And that's going to continue through the end of the year and likely into next year. We still are inventory constrained. Okay. The other insight, remember, we don't only have the static pool of these are the products for sale in the marketplace, right? Single family homes, condos, townhomes. The pool is dynamic. Stuff gets pulled out of the pool because it's sold or because the listing expires and it just disappears from inventory. Or because it's withdrawn, same thing, it disappears from inventory, but it was sort of a desired, we want to withdraw rather than we're just letting the listing expire, right? So there's those three ways that inventory comes out of the market. But new inventory can come into the market, and that is the newly listed resale single family condo or townhome. Well, townhomes saw a slight increase in October of new listings vis-a-vis September. Single-family residences and condos, newly listed resale properties came down. Right, so in other words, that's showing you what's going to be happening with inventory next month. If new listings are coming down, and if they're running below, for example, the rate of removal from inventory through sales, withdrawals, or expireds, that means the overall inventory number is going to be coming down, and it's been coming down most of this year. Okay, so that's what's going on with inventory. And remember, these are not the real inventory numbers. These are the reported into the MLS inventory numbers, which include stuff that we had been looking at a few months ago. 40% or so of what's listed in the multiple listing service is kind of fake inventory. It's not real because it's priced so high vis-a-vis the market that buyers are not seeing it. Buyers agents are not seeing it, right? It just comes up in this macro data view that I'm able to give you, and the corrupted macro data view that you get from other places that talk about, lots of inventory. And I say corrupted data because they're including things in that data that should not be there. It creates what statisticians refer to as dirty data. The data need to be clean. They need to be parceled to remove out that junk, to give you the actual real information. So that's what I do here. Okay, one more insight or one more piece of data, and that is the back on market. Now remember, when something goes into contract, a house goes into contract, a buyer makes an offer, a seller has it listed, newly listed or listed for a while. A buyer decides, I like it, I want it, and they make an offer. And buyer and seller get into a negotiation, they agree on the terms. Okay, I'll sell this to you for this price, and I'm willing to buy for this price, right? We're in contract. Contracts usually last 30, 40 days in the Las Vegas market. During that 30 days, the contract is at risk. It could collapse. And there are a variety of reasons why contracts may collapse. It could be an appraisal mismatch. It could be an inspection mismatch. The due diligence process, buyer finds lots of things, makes a request, seller says, no, you want it? This is what it is. Or it could be an inspection comes in and an inexperienced buyer and buyer's agent say, oh my gosh, this is terrible. There's like new paint that needs to be applied and caulking around a sink, and freak out about an inspection report that actually is quite clean. And a seller says, I'm not going to pay to redesign, redecorate, etc. I'm selling you a house that's in great condition. If you want to change the paint color, that's on you, buyer. That's not something reasonable for me to do. And so, right on either side, it's a negotiation. And sometimes those negotiations fail for a variety of reasons. Right? There's other things. A buyer might lose their job. A seller may lose a job that was taking them out of town that was going to cause them to have to relocate. So there are reasons why things fall out of contract. The house that falls through, it's an old story. As long as real estate has been transacted, some contracts fall through. But since 2020, we've been seeing deplorable back on market numbers. Now, back on market means something went into contract, it fell out of contract, right? Second step. Third step, it was relisted back into inventory. It was back on market, right? So we see those failures that happen to come back in market because those are recorded into the MLS as back on market, and they're easily found. What's not as easily found is those things that fail that don't come back, right? It could be the seller decides, I'm not going to do it again. I'll just stay. Or a seller decides, maybe I'll relist it in a year when things are more interesting in the market, right? Or maybe a seller decides, you know what, I'm going to rent it out. I'm not going to bother selling. I'm just going to keep it and rent it out. Or whatever else, right? Those failures, they don't come back into the market. And so the back on market number is an undercount of failures. And I don't know how big that undercount is, right? It's maybe another 5%, another 10%. It's not a doubling. I don't know how big it is, but the best measure we can get for contract failures is back on market. And so that's what I'm reporting to you here. I'm calling them failures. I'm calling them back on market. I'm using the terms synonymously. I just want you to recognize that it's actually an undercount of some unknown, but probably small level for contract failures. And since late 2020. I've been watching this every month, and these numbers have been running between about 22 and 33%, right? So a little less than a quarter of all contracts failing, and a little up to about a third of contracts failing. And I've been telling you these are deplorable numbers, right? This number should be way below 10%. Right? But let's just say the normal is 10%, right? It should be way below that. But let's say the normal is 10%. We're running 2.5 to 3.5 times higher than normal. And we have been now, right, since October of 2020 through October of 2025. Really bad. So actually that's 6 full years. Take that back. 6 full years. We've been running at these horrible back on market numbers. Now, Redfin recently has picked up this concept and said, oh, back on market numbers, well, they're really high, right? Very few people have been talking about this. And I don't know where Redfin gets their numbers. Their numbers are corrupt. They're corrupt because they're looking at dirty data, but I don't know what data they're looking at. I'm unable to reproduce their numbers, right? They're dramatically undercounting. So just know you can read a headline, oh, it's really bad, worst ever from Redfin, but their numbers are wrong. They're too low. Where are the real numbers? Well, October was kind of devastating. Remember, I had told you that the September pending, meaning went into contract but had not yet closed, numbers were higher than what we had seen the month before that, which suggested that the October closed numbers could actually be pretty strong, could go up from what they were in September. But we didn't see that. We saw the October numbers come down, which means something happened, which means the pending numbers, which means the back on market numbers are going to look really bad. Well, how bad do they look? Single family resale, 698 failed, meaning back on market contracts, 30.1% of all of the contracts that were written failed. I'm right. I mean, 30.1%. That's really, really bad. But it gets worse. 128 condo contracts failed. That's 35.6% of all condo contracts failed. 35.6%. We're way over 1/3. Townhomes, 105 failed. 35.1% of all of all townhome contracts failed. Failed measured as back on market, meaning we're undercounting the failures. Horrible, horrible, horrible. And if you are wanting to do a property transaction, whether you're the buyer or the seller, you're at risk, right? 1/3 of contracts. For every 3 people out there who are trying to transact on a piece of real estate, 1 of them is failing. Horrible, horrible numbers, right? Make sure you're talking to your agent. Talk to me, reach out, talk to me. I'll talk to you about it. We'll figure out how to make sure you get a good contract that's going to be stable, that's going to work, right? I very rarely have a client who actually fails to get through a contract for a variety of reasons, because I do things knowing where the common issues are, protecting against those common issues, knowing where the less common issues are, and trying to mitigate any potential problems around those less common issues as well. So I'm not going to tell you I've never had one. I've had, across my career, a few, a small number. A really small number when you look at the data and you say, wow, more than 1/3 of condos, more than 1/3 of townhomes, and almost 1/3, 30.1% of single family homes in October fell out of contract and went back on market. And not fell out of contract and not in the market, right? Not those failures that we don't see. These are the failures we do see. Please, I am Justin Miller with the Chung Miller Group. We help people buy and sell homes. We help people build wealth through real estate. And part of that is by protecting our clients so that you're doing the right things, pricing right as a seller, making proper offers as a buyer, putting in contingencies or terms and contracts that allow us to get through the places where things may fail, right? I protect my clients because the market is really harsh, and the market's been harsh in this environment for quite a while, and we're running at 3 years of astoundingly low transaction volume in this market, and we're running at 6 years of really high contract failures in this environment. You need to pay attention. You need to be working with somebody who actually knows, not just a friend or a family member who just started doing this. This is really important, right? This is maybe the most important transaction you'll engage in your life, or one of certainly the most important transactions you'll engage in your life. You want to have real, valid expertise sitting on your side, helping you get through these things. And by the way, these analyses are true for new construction as well. And more than 25% of my clients are actually buying new construction properties. Things happen with those as well. When we see contract failures all the time, that's a normal part of the new construction business. How do you get your money back? Is it at risk? Right? What do you do with regard to design issues or being, oh, you could do this, you could do that. One of them's more expensive and contributes nothing to the value of the property. One of them actually will make a really big difference in the resale value of the property. Well, reach out to us. I'd love to be able to help you. I'll talk to you in the next video. Thanks.